Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, and if you're French, happy Bastille Day. If you're not French, happy Friday. This is Peter Lewis with Money Talk on Friday the 14th of July. Thank you for listening, and thank you for making my Money Talk podcast one of the most listened to financial podcasts in Hong Kong. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China's closely watched June trade data badly missed expectations, with exports contracting more than expected in June, hit by shrinking global demand and adding to concerns about the mainland's faltering economy. Exports from China shrank 12.4% year-on-year in June, following a 7.5% fall in May. It was the second straight month of decline and the steepest drop since February 2020, and imports fell 6.8%. The Bank of Korea kept its base rate unchanged at 3.5% during its meeting yesterday, as widely expected. It's the fourth straight meeting the Bank of Korea has done so after last hiking rates in January, as inflation continued to ease. Thursday's move came after the central bank delivered 7 straight hikes since April 2022. US wholesale inflation slowed more than expected in June, a second signal in as many days that the Federal Reserve's rate-rising campaign is helping ease price pressures. Producer prices, which is a leading indicator of inflation, edged up 0.1% month-over-month in June, following an upwardly revised 0.4% fall in May and below market forecasts. Core PPI, which strips out volatile food and energy prices, also rose 0.1% last month, slowing the annualised rate of price increases to 2.6% from 2.8%. And the German government has unveiled a landmark shift in how it views its relationship with China. In its first ever China strategy, it says China is increasingly emerging as a systemic rival to the West. Foreign Minister Annalena Baerbock said Beijing had become more repressive internally and more aggressive externally, and while it remained a partner, its role as systemic rival was beginning to dominate. But the government rejected the notion of decoupling from China, but stressed the need for China to for Germany to de-risk and diversify its supply chains and export markets away from China. On today's programme, I'm joined by Francis Lund, the CEO of Securities, and Andrew Sullivan, founder of Asian Market Sense. With a view from Australia is Toby Lawson, CEO of Statton Partners. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street, US stocks rose Thursday after another key inflation reading. The Producer Price Index came in lighter than expected. The S&P 500 closed at its highest level in over a year, climbing 0.9% to reach 4,510. All 12 sectors in the S&P 500 are on track to end the week higher, with communication services and energy the best performing sectors. The S&P 500 is now 3% above the level it was at when the Fed first hiked rates in March 2022. The Dow added 48 points, or 0.1%, to close at 34,395. The Nasdaq Composite advanced 1.6% to end at 14,139, led by gains in heavyweights Alphabet and Nvidia. It was the fourth consecutive day of gains for the major averages. The good inflation news sent rate change expectations for the rest of the year tumbling. The market is now pricing in a single 25 basis point hike in July, no move until the year end, and a rate cut then in January 2024. Yields are sharply lower on the week. The yield on the 2-year note dropped 11 basis points to 4.63% yesterday, leaving it 32 basis points lower on the week so far. The 10-year yield declined 10 basis points to 3.77%, leaving it 30 basis points lower on the week. And the 2 to 10s yield curve is at minus 86 basis points. That's up from a record inversion of minus 110 basis points a week ago. The US dollar index fell below 100 Thursday, marking its lowest level since April 2022, a month after the Fed's tightening cycle kicked off. On Thursday, it fell 0.8% to 99.78. It is now down 2.4% for the week and on pace for its worst week since November. Chinese stocks surged Thursday after Beijing pledged to support tech platforms, suggesting a crackdown on the sector is drawing to a close. Hong Kong's Hang Seng Index jumped 490 points higher, that's 2.6%, leading gains in the region, and that takes the gains in the Hang Seng for the week so far to 5.4% and on track for the best week since January. Technology stocks in Hong Kong rallied for a fourth day after Premier Li Qiang met with senior executives from the country's leading technology firms on Wednesday. He vowed to help them grow, saying they needed to push to increase their international competitiveness and dare to compete on the global stage. Premier Li said the government would normalise regulation and called on all levels of government to create a better market environment. The Hang Seng Tech Index surged 3.8%, taking its gains for the week so far to almost 9%. Alibaba rose 3.2%, while Tencent added 2.9%. Mainland Chinese markets were also all up, with the Shanghai Composite Index gaining 1.3% to 3,236. Futures markets are pointing to gains of 160 points, or 0.8% for the Hang Seng at the open, and you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
And on this bright and hot Friday morning, we welcome Francis Lun, the CEO of Securities. Morning, Francis.
Hi, good morning.
And also with us, Andrew Sullivan, who is founder of Asian Market Sense. Morning, Andrew.
Good morning.
Let me ask you, first of all, then, about this support from Premier Li Qiang for the tech companies. He met with senior executives from several of them. It included Alibaba, ByteDance, Meituan, JD.com, and he urged local governments to provide them with more support. He called them trailblazers of the era. Is this now a real change in approach from the Chinese government, do you think, to the platform companies?
Yeah, definitely, because all these platform companies have been under pressure since 2021. So for 2 years, 2.5 years, they've been under pressure to do this and do that, and then firing people, and they stop growing. Now they got the green light from Premier, said, okay, all is forgiven. Now you can start growing again.
Yeah, I think, though, the problem is that they're not going to go back to be allowed the free enterprises that they were prior to the crackdown. I mean, Beijing has obviously set rules for what they can and can't do. There's common prosperity that they're still trying to adhere to. So, I think from an investor's point of view, they're not going to be the golden geese that they used to be.
And when you look at their size now, I mean, look at Ant Group. It's its valuation 75% below where it was when it was going to IPO. And Jack Ma's companies, Alibaba's companies, they've lost about $850 billion as a result of this crackdown. So they're, in some ways, you could argue they're just a fraction of their original size and just a sort of a shadow of what they used to be.
Yeah, they've been cut down to size because previously there were something like 7 billion Hong Kong dollars or something like that, and they're richer than the government, and they're in every single sector of the economy. So the government feared their power, so they cut them to size. Now they're at the size that the government can control, so now they can start growing again.
And I think that's the key thing. I mean, the government wants to have control. It's put party members within there and party secretaries in there. The government can see fully what they're doing. I mean, historically, they were worried about the amount of commerce that was going through, the fact that these companies knew more about people's personal savings and spending than the PBOC did. The trouble is that innovation being removed means that effectively the economy is not going to grow in the same way it was prior.
So how do they innovate if their first task, if you like, if their first mission is to be loyal to the government and follow Communist Party sort of doctrine and Communist Party policy? How do you innovate when you've got Communist Party members on your board that are ultimately dictating the direction the company goes in?
Well, it's difficult, but they learn. I think I spoke to the people in the movie industry. I said, with so many restrictions, how can you survive? He said, we learn how to operate under these tight laws.
I think that's right. I mean, they will change. I just don't think you'll see the same rate of growth that you saw historically. I think the other encouraging thing, though, is it means that obviously a lot of people that were hesitant about giving approval for games and for new services are probably going to be more inclined, and we'll see that process speed up But as Francis was saying, they'll have to learn, they'll have to adapt, but it certainly won't be the free enterprise that it was prior.
And there's always the risk, of course, that there could be another crackdown if they think that one of them is breaking the rules somewhere.
Well, I think that's what investors are now aware of, the fact that Beijing can change its mind overnight. And I think that's not just for the e-commerce sector. I think that's actually in all businesses there, that it's the risk of operating in China and the risk of government change of policy is much higher than it has been.
I mean, Premier Li Qiang wants them to compete internationally. You could argue that 3 years ago, Alibaba, Tencent, they were in a good position to compete internationally, weren't they? They'd made some good acquisitions, but they've been forced to divest quite a few of them. Are they now in a position to compete internationally?
Well, I think ByteDance is the one which has competed successfully overseas. And had they not been constrained by the Indian government, they would have dominated the Indian internet scene. But I think in Southeast Asia, I think they still can carve out a niche for themselves. You just look at the electric car industry. I think 2 years ago, nobody expected the Chinese electric car industry to be forced to be reckoned with. Now they are the largest in the world and the biggest exporters in the world. So I think they have the ability to carve out international markets.
I think the trouble is the rest of the world has caught up with them. So they had an advantage previously that's been taken away from them, and they've got the added restriction now of whatever they do internationally has got to be approved by the party. Previously, you look at the Ant payment system, the Tencent payment system. They were world leaders, but the rest of the world has caught up now. So it's going to be much more difficult.
And the governments have been told at all levels to reduce red tape, create a transparent and predictable regulatory system. Do you think that's going to happen? Because once you've got these people who are creating this red tape, wrapping you up in it, it's very difficult for them to learn how to stop, isn't it? They want to carry on finding new rules and regulations that you should be following or have broken somehow.
Well, I think they will try to do it because everybody will try to listen to the central party. I think you take the case of Zhejiang province, and Alibaba is their lifeblood, and just about every party secretary, provincial officials depend on Alibaba's well-being. So they don't want to kill the goose that laid the golden eggs.
Well, they've already strangled it, to be fair. But they're hoping to put some more life back into it. But I think that's right. They will try. The other big thing is the fact, I think, that the threat of being done for graft by approving these games and these new activities is probably reduced. It's not gone away, but it's reduced, and that will help local authorities to reduce the red tape.
Because they've acted in the past. They've been terrified, haven't they, of missing something, getting something wrong, and then getting hauled up in front of the disciplinary committee.
Well, I think it's the difference between being told to get things moving and versus being careful about not breaking the rules. So I think that's obviously in their benefit.
Well, what do you make of the market reaction to this? The Hang Seng jumped 490 points yesterday. It's up so far for the week now, 5.4%. It's on track for the best week since January. Is this now the green light for people to start getting back into Hong Kong stocks?
Yes, I think what the Premier Li Qiang said is exactly what the investment community wanted to hear. It's just the letting go of controls and then let the internet company platforms do what they want to, let them grow again, let them hire people again. I think for the past 2 years, all the share prices of all these platform shares have plunged something like 75%. That is really quite a disaster. Now we can start growing again. I think this is the good news that everybody expected.
I'm not quite so bullish. I think a lot of it was short covering. Because the whole index went up, so you saw, even unrelated stocks going up significantly, which was short covering, and then they were reshorted again at the end of the day. So there's still a lot of concern out there. And I think a lot of investors, we've seen as Francis was saying, the Chinese will tell the investment community or say to the investment community what it wants to hear. But a lot of investors now, we've heard this so many times before, that a lot of investors will actually, they'll cover their short positions and then they'll sit on the sidelines again, waiting to see whether we really see policy change or whether it is just words and trying to talk the market up.
We're seeing that. We're hearing from Goldman Sachs Prime Services desk. They're saying their hedge fund clients have been buyers of Chinese equities for the first time in about 7 or 8 weeks. So, but what about institutional investors? They've been left quite underweight, haven't they, on China? Do you think maybe there could be some panic buying from some of them as they start to sort of scramble to get back into the market, or are they going to take a much more longer-term wait-and-see approach?
I think it's the longer-term wait-and-see. I mean, realistically, everybody piled in, once they pivoted on zero COVID, expecting a strong rebound and a strong recovery, and that didn't happen. And I think having been sort of caught short once, people are going to be much more reserved this time around. Plus the fact, US yields have gone up, so, there are lots of good other alternatives without the risk of policy change.
Well, we had some trade data out of China, badly missed expectations. Exports fell 12.4% year on year. That's even worse than the 7.5% fall we saw in May. Exports to the US, they fell almost 24%, the 11th straight month of declines, and that's the worst result since the slump at the beginning of the pandemic. Shipments to Asia and South Korea, Japan, Taiwan, Germany, Italy, the UK, Netherlands and Canada all fell by double digits. And imports, imports were also down as well by 6.8% year on year. The hits just keep on coming, don't they, for the Chinese economy? You can sort of almost understand why Li Chang really needs private companies now to step up to the plate and somehow drag the economy back out of the mire.
Yeah, I think that's the problem of excessive lockdown during the pandemic years. And China almost completely locked down in 2022. And big companies like Apple and others really suffer from it. So they diversify their suppliers and they shift productions to other Asian countries. And then this is the result of what the Germans call de-risk, and then what the Americans call decoupling. So China is reaping the results of its terrible, stupid policies.
Yeah, I think Francis is right there. I mean, the other thing you've got to take into account here is the fact that, the global economy in the meantime has slowed down. People, as Francis was saying, have moved their supply chains. And the other thing is that, the SOE companies were never good at creating jobs. It was always the SMEs and the private enterprise that were creating a lot of the jobs. We haven't seen a change of policy on the education sector. That used to take about 25-30% of university graduates each year. And this is why they have a youth unemployment problem, because they've cut the sectors that were really creating new jobs for the youth, and that's a big driver. So you've got a situation where there's not a lot of domestic confidence for those reasons, and also because the property sector is so bad. You wake up every morning and your house price hasn't gone up for the first time in 20 years.
Or gone down in some cases.
Property gone down. And I think, looking forward, we get another big dump of data on Monday, which is going to be very important. And it will probably underline why China is so worried, and it's trying to talk the market up as much as it can, because it can't afford to do fiscal intervention. It's got very limited way of going back, and it doesn't want to do the previous stimulus because that just created a bubble. So it's got very limited opportunities.
So what does it do?
Well, it's doing what it can do, which is to try and talk it up.
Talk it up. But investors will eventually see through that, won't they? And they'll say, we need some action as well here, not just the words.
Well, that's what I'm thinking. I think we'll see. We're seeing this this little blip at the moment on good words, but it can unwind very, very quickly if we don't really see action. And I think realistically, difficult though it is, China is going to have to do some structural changes because it can't afford to do a fiscal intervention, and it doesn't want to do a monetary. It's got limited. It talks about moving 10 basis points on its long. That really doesn't move the dial for a lot of people.
So its number one priority, surely, it's got to decide what it wants to do about the property sector, hasn't it? Because, in effect, the property sector is bust. And we don't even know the true extent of the damage there, because we don't really know how much indebtedness the property developers have off balance sheets. We don't know the true extent to which banks are exposed to them either. But somehow the government has got to deal with this, hasn't it?
Yeah, they have to. I think just what the largest property developers alone is indebted to the tune of 2 trillion yuan. So, so if you times that, so it's something like 20 trillion yuan of property debt. And which you really have to deal with, because the property market has been oversupplied for years. I remember more than 10 years ago, I saw all these empty flats. I said the property bubble will burst sooner or later. Of course, it was later. It burst in 2020. And the government will take, I think, more than 10 years to recover from it.
I think it wasn't so much of a bubble as a Ponzi scheme, because it was in everybody's interest for prices to go up.
Yeah, especially the local government.
And local governments wouldn't allow prices to go down. They would only sell land at a higher price to keep the scheme going. And I think it's interesting. I mean, I think we're hearing this morning that one of the northern provinces has actually, gone to the central government and said, "Look, hands up, we're bust. We need to be restructured." And that's what they're going to have to do. They'll have to restructure that government debt to allow the local authorities some budget, or they'll have to change the tax system.
Yeah, meaning bailing out the poor provinces.
Yes, well, I think Jiangsu province has got something like 12 years' worth of supply of property to work its way through. Tier 1 and Tier 2 cities, not going to be a problem. Everybody wants to live there, still good demand. But Tier 3, Tier 4, much more
the
difficult.
northern provinces, they're losing population.
Yeah.
That's the big problem.
Yeah.
So as well as the domestic issues, I mean, China's got international issues as well, hasn't it? The external environment is not looking good, so China can't rely on trade. It does seem that announcement from the German government's quite significant, isn't it? Where it's talking about, basically, it's come up for the first time now with a specific China strategy, and where it openly says it's going to sort of de-risk, as it calls it, from China, but rely less on China, move supply chains from China. So it does seem that the international environment is also worsening.
I think what Germany wants to do is really diversify the supply chain for some of the key commodities like rare earth metals and other things like that. And so I think it will hurt definitely. I think you look over the horizon. Biden's Inflation Reduction Act is actually aimed squarely at China's EV, especially the electric car battery sector, because right now 60% of the car batteries are made in China, and Biden wants to shift that to the U.S., and that will hurt even more.
Yeah, the thing is, Germany historically has been a big reliance. There's been both ways, trade with China and its exports to China. And obviously, its historic car manufacturing in China has been huge ever since Volkswagen went there back in the 80s, I think it was.
Yeah, that's right.
And the fact that it's made this decision really shows that it's looking to diversify. And it following really what Australia had to do when it had the spat about the Australian government saying it wanted an investigation into where COVID came from. China shut it down, so it had to find alternatives. And I think more and more countries, having previously happily been reliant on China for trade in both directions, have now decided it is too risky.
It does also show, doesn't it, the huge price that maybe China is paying for its support for Russia and its cozying up to Putin. I mean, Germany openly said that in its report, that, this was damaging to China's EU relations. And you have to ask, is it really worth it?
Well, I think obviously President Xi thinks it is, because, he sees that, he sees this as an almost binary battle. And if Russia fails, then that's one less ally to China, and I think that's a big concern for him.
Yeah.
What about inflation? That's been the big focus of the week, hasn't it, over in the US? We had, first of all, consumer price inflation on Wednesday. The annual inflation rate slowed to 3% in June compared to 4% in May. And then also last night we had producer price data as well, which showed a bigger slowdown than expected in the producer prices. The markets have really taken this to heart, haven't they? Particularly in the currency markets. The US dollar's been absolutely hammered since this data come out. But do you think at last the Fed's on top of it?
Yeah, I think so. I think finally we see light at the end of the tunnel. I think rate increases will probably end sometimes in the next few months. I think after one more rate increase, I think the Fed will have to stop, because the only thing they haven't really bring under control is the rent rates. Because the rental market is still very tight, but the food prices, energy costs are coming down. So I think the Fed managed to bring down inflation without causing a recession in the U.S.
Yeah, I think there's still a very tight labour market, and we saw the decline in initial claims yesterday. I think that the thing is, though, I think the market is over-discounting rate cuts. I mean, I think the Fed is making it very clear that it knows it's going to have to keep these rates higher for longer. Whereas, the markets are saying, oh, well, look, maybe one more hike this year and then we'll see some cuts next year. I suspect that we won't, because getting the inflation down, those last 1% or whatever, always takes a lot longer.
That's hard, isn't it?
Yeah,
and
you've got
tough.
Because you've got people's wage expectations coming into effect then. The fact that we've also got the fact that student debt isn't going to see the relief we thought it was going to, so people will have less money to spend. And hence they will be looking for higher wages, and that's going to keep that market tighter for longer.
Yeah, even the actors are striking.
Yes.
But the risk is this can all turn so quickly, can't it? All we need is one set of bad inflation data that maybe is higher than expectations, and then suddenly everything changes again and people start worrying that maybe the Fed isn't on top of things yet and more rate hikes are to come.
Well, they've said they're data dependent. Every meeting is live as far as they're concerned, and it really is dependent. And as you say, I mean, we only need to see something fall out of bed. The higher oil prices will have an effect. I mean, we saw those oil hit a new high last night because people aren't expecting inflation and that they are effectively expecting rate cuts, and I don't think those are going to come in any time soon.
What do you think this means for the markets? I mean, the statistic that I'm sort of surprised about is that the S&P 500, it's actually 3% higher than when the Feds first started raising rates, 14, 15 months ago. So we've had 5 percentage points of rate hikes, but US stocks have ignored it all and are higher than when the Fed started. Do you think this can continue?
Yeah, I think this latest rate is really based on the economic growth, I think, or something like innovation, like AI. I think that's why the S&P and Nasdaq are up. But you look at Dow Jones, which represent more of the old economy, they're not really up that much.
Yeah, I mean, it's been focused on those 7 or 8 key tech stocks.
Yeah, the Magnificent Seven.
and the other thing is, because so much of this is invested via ETFs, if those stocks go up, then the ETF has to buy the whole of the market, not just those stocks. So you get the markets drawn up by that. But I think it also indicates that a lot of these stocks are just primed for perfection. And as we go into this earnings season, if they miss, then they'll be sold. But I think more importantly, if they don't give a rosy outlook as demand in the second half and future, then again they're going to get sold because they are just priced perfectively.
There are signs that the rally's broadening out at the moment, isn't it? We've seen industrials like the Dow Transport start to move up. Some of the small caps as well. So the things that are sort of dependent upon a good economy seem to be doing okay.
Yeah, I think the recession that everybody had predicted hasn't come and will not come, I think.
You think it won't? So you think the Fed's pulled off what everyone thought was impossible and guided inflation down and avoided a recession?
That's right.
I think you're right. It's all good until it isn't. That's going to be the thing. Everybody's assuming it's all going to be good, but one hiccup, and I think you'll see a lot of people bailing very quickly. And then you've also got to remember, and now with America priced perfectly, a lot of investors are now looking overseas. Is it worth chasing the stocks at these levels, or can I find good returns elsewhere? And we've seen that in Japan, we've seen that in Korea and India and Korea. All of these markets have seen good inflows recently. Japan had a race ahead. It's consolidating slightly, and I think you'll see people go back and have another look.
And what about the US dollar? The US dollar index has fallen below 100 now, so it's at its lowest level in about, 15 months, I think it is. The yen in particular, isn't it? That's really caught a bit of a tailwind. People thinking that the Bank of Japan is maybe going to stop yield curve control in the next couple of months, maybe. So what does this mean for the US dollar?
Well, it keep falling. I think because the rate increase cycle is coming to an end, and you don't have the interest rate difference between the yuan and the US dollar now. So I think next year we see the renminbi rising again.
I mean, it's been a hugely crowded trade for so long, and the fact is, once it starts turning, a lot of people start heading for the door. But at the same time, looking at the yen, Ueda's already said he's going to give himself 18 months. Obviously, he's not going to say we're going to change overnight because the market will front run him. So he's given himself a long enough runway to be able to review what's going on. He wants to be very sure that the inflation is real inflation there, because in the past they've made mistakes and acted too early. So he's going to do that, and he will gradually change. I think he doesn't want the market to know that he's going to change, because they've got too much of they're owning too much of the market in the bonds to be front run by the rest of the market.
Well, thank you both very much. Great discussion this morning. Have a good weekend. You heard there Andrew Sullivan, who is founder of Asian Market Sense, Francis Leung, who is the CEO of Geo Securities.
Peter Lewis's Money Talk.
I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia. Morning, Toby.
Good morning, Peter.
Now, we have some breaking news. Michelle Bullock has just been announced as the new governor of the Reserve Bank of Australia by the Australian government. Toby, I've never heard of her. Can you tell us a little bit about who she is?
Yes, Michelle Bullock has been announced this morning as the new Reserve Bank governor, effective from September, when Philip Lowe's term expires. She's currently deputy governor. She's been with the Reserve Bank since 1985, so she's a career bureaucrat. She's the first woman in the Reserve Bank's 63-year history to lead the central bank, with the 9th governor. And she arrives at a time when the Reserve Bank's going through a significant review of its processes and how it communicates in relation to monetary policy and how it determines monetary policy. So it'll be a very interesting time for her, but she's clearly an experienced candidate, well entrenched within the Reserve Bank, and has been chosen because of that.
And do we know anything about her sort of stance? Is she a hawk? Is she a dove? Is she one of those people that's, has been saying that interest rates need to move higher? What's her sort of stance been like?
She's been very consistent in line with with Philip Lowe, the current governor, in terms of most recent speeches. Very much in line. Doesn't appear to be outside of the diktat that's sort of driven by Reserve Bank communication. So I think she's a steady choice. And I think one of the factors that drove the government to choose her was the fact that they're going through a full review, and given her experience in the organisation, to implement that review and implement new policy around Reserve Bank, I think she's the appropriate choice. And there's no political, element to it, which is also really important to ensure that the Reserve Bank governor remains very much an independent decision.
And the Reserve Bank of Australia has come under some criticism, hasn't it, under Philip Lowe, particularly because he said a couple of years ago we're not going to be raising rates, only to go and raise them by 5 percentage points shortly after that. So they sort of have come under scrutiny, haven't they, about how they've got inflation wrong.
Yeah, it was the most unfortunate quote from the Reserve Bank governor back when he mentioned that. And to be fair, central banks around the world had to all react in a similar manner to what the Australian central bank did. But he's sort of worn this, unfortunately, as his legacy. And to some extent, the government could be criticised for using it as a bit of a deflection, in terms of saying, well, it's all because of the Reserve Bank that we've got interest rates at going up to 12 times, 13 times, and 4.1% from pretty much zero. So to some extent, he's been a bit unlucky because, everywhere around the world, central banks had to move very aggressively to arrest the cost push inflation that came through post-pandemic. And so unfortunately for him, that'll be his legacy. But I suspect, now that he's out, there's a clean slate, a chance for Michelle Bullock to step up and for the government to, ensure that the independence of the Reserve Bank is sustained.
And to be fair, he wasn't the only one who got it wrong, was he? Jerome Powell famously said inflation was transitory a couple of years ago and then ended up having to ban the Fed from ever using that word again. But it does look like, from the data that we've seen this week, that maybe the Fed is on top of things. We've seen US inflation, consumer price inflation at the slowest pace in 2 years. Producer price data out last night showed PPI also slowing as well. This has had a big impact on the markets, hasn't it?
I think the word transitory might be back in fashion. I was reading this morning about these recent PPI and CPI figures as, justified that actually a lot of the big move in inflation from 2021 was in fact transitory. It's just a matter of how long is transitory by definition. Interestingly, the PPI was as low as since 2020. So I think it's fair to say that all of the impact of the supply chain constraints driven by the pandemic, and also some of that pent-up demand that was driven by people not being able to spend money, has now basically come out of the inflation figures. So you've got base effect coming out, plus you've got the reality that the prices on the manufacturing side or the input side have definitely become more disinflationary. Where the issue is now is that last mile. I'm not sure if any one of your listeners have renovated a house, but, it all looks very good up until probably the last 10% of the work seems to take forever. So that last mile will be hard now. And so that's why I think the market is still predicting that the Fed will raise 25 basis points, even though the data this week is really strong in terms of a look at reduced inflation. There's still a bit to go, and the one thing they don't want to do is to let the foot off the throat, so to speak, ensure that it stays down.
So it looks like then we've got a rate hike coming this month in a week or so's time. But then the markets are basically saying no more rate hikes now for the rest of this year, although the Fed was saying there's going to be 2. And markets are now also pricing in a rate cut again in January. What do you think of that?
It's slightly premature, I think, because only a month ago we were talking pretty much the opposite. We're going to, as you mentioned, 2 or 3 rate hikes potentially, even mentioned by the Fed, plus no rate cuts for the foreseeable future, at least into the second half of next year. So that's the market, reacting to good news. I think probably there's a little bit to play out in terms of how the Reserve Bank, or central bank, should I say, the Fed, are navigating this soft landing. I still don't think we're quite convinced, but it's certainly looking better after this week. So I suspect that's a little bit of market being a little preemptive.
What does this mean for the US dollar? That's the asset that's really taken the biggest hit from this, isn't it? The US dollar index fell below 100 last night, so it's at a 15-month low now, and we've seen some big rebounds in the Japanese yen, the euro, the British pound in particular. Do you think now the trend has reversed for the US dollar?
Yeah, it definitely been a significant move. Sub 100 psychologically one bit, but also technically looks like it has broken down. But again, I think it's often an overreaction. So let's see how it settles in the next month or so as we see the data come through. But earnings season in the US to see how the corporate sector's going in reality, as opposed to purely looking at economic data. So there's a lot to play out over the coming months, and as we come out of the summertime in the northern hemisphere, there'll be more and more data, more and more eyes on, more and more attention. So I think that laser focus of attention from the market will sort of you'll come into play in the next couple of months. So right now, I think it's a significant break technically in the dollar index, but it could have overshot already.
Let me switch attentions to another country, to India. We had inflation data out there as well, and it's moved in the other direction there. It accelerated for the first time in 5 months to 4.81%. It was at 4.31% in May. In particular, food inflation increased to 5% from 2.91% in May. How's the government reacting to that, or the Reserve Bank of India reacting to that?
Well, you've got to look at it specifically in India. Key staples in India are onions, tomatoes, chilies, and ginger. And the tomatoes supply was absolutely devastated through unseasonal patterns in the monsoon in the lead up. So you had a huge spike increase, a 300% increase in tomato prices. There's 20 million tonnes of tomatoes produced every year, or demand in India. So both onions and tomatoes represent quite a significant input to the staples for all Indians. And so when tomato prices went up, that led to the big spike in the inflation figure. But if you look at all of the other elements of inflation and you strip out that, the increases were pretty mild. So I don't think it changes policy for the Reserve Bank of India. And it's something that we've seen historically in India, where you do get these quite volatile moves in staple prices due to seasonal, monsoon conditions. So it's quite a volatile series. So I think for those who go to McDonald's in India, I read somewhere that there were no tomatoes in McDonald's burgers for a period of time.
I saw that. They've taken them off their menu, and local farmers are reporting large-scale thefts of their tomato crops. There seems to be a bit of a tomato crisis going on, because if you like masala, you need tomatoes for that, don't you?
Yeah, well, they've had onion crises previously, sort of 2010, 2011 and 13, I think, where, similar type spikes in onion prices caused the inflation figures to move quite aggressively. And so it is a significant short-term factor, but shouldn't play through in terms of inflation expectations overall in India.
Let me ask you about one other thing going on in India, and this is Foxconn pulling out of its joint venture with its local partner Vedanta to open up an electronics manufacturing factory over in Gujarat, which is Narendra Modi's home state, isn't it? How significant is that? Is Foxconn going to carry on trying to look for a new partner?
Yeah, I think that's what I gather. Being a long distance away now, it's hard to read it. I guess psychologically it's a blow to Modi, because the Made in India, the desire to develop a semiconductor market in terms of manufacturing in the state of Gujarat, but also more broadly in India, has been sort of one of their headline drives. And the Foxconn Vedanta deal was, $19.5 billion JV, not insignificant. So, yeah, it has a psychological impact. Both companies have said that they're still going to pursue. The technicalities around why it happened, I don't know, and I don't have enough information as to what happened to drive them apart from the fact that they probably found it difficult to find the technical partner to deliver on the manufacturing. So I think that both companies have said that they're going to continue to invest. And we know that the semiconductor sector in India, I think, is going to be $63 billion by 2026. And so there is a commitment for the government to continue to invest. There are incentives for companies like Foxconn to invest in manufacturing in India. I think it's so maybe it's just a bit of a hiccup, and maybe it's more just a relationship between those two companies that they couldn't get through. But I don't know enough from where I sit to be able to give, a real value judgment as to what happened.
Toby, it's always a pleasure. Thank you very much indeed. That's Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia. Thank you very much for listening this morning and this week. Don't forget to take a look at my daily newsletter, which you'll find at peterlewismoneytalk.substack.com. I'll be back on Monday. In the meantime, have a great weekend. I'll have more business and finance updates for you on Monday morning. Joining me are Alex Wong, Director at Alex KY Wong Asset Management, and Christopher Lee, Partner at Farron Augustine and Alexander Investments. And providing a view from mainland China will be Brock Silvers, the CIO at Kion Capital. Have a great weekend.
Money Talk